Most wealthy people aren't picking stocks. I know this because when I tried it, it left me stressed, overwhelmed, and constantly checking my phone. Then I learned something that completely changed how I invest. Most millionaires aren't trying to get rich from one stock. Instead, they use a simple, boring system that quietly builds wealth over time. I'm Davina. I've worked in accounting and finance for 15 years and went from £27,000 in debt to building a six-figure portfolio. Not by taking huge risks, but by following a calm, repeatable strategy. So in this video, I'll show you why I stopped picking individual stocks, what I do instead, and the beginner-friendly investing strategy that changed everything for me. Let's get into it. If you want to build wealth, the advice usually sounds the same. Pick the right stock. Find the next Tesla, the next Nvidia, the next big winner. And for a long time, that's exactly what I thought investing was too. But the more I learned about investing, the more I realized that's not how most long-term wealth is actually built. Because most self-made millionaires, most ISA millionaires here in the UK, aren't spending their time trying to predict winning stocks. Instead, they invest consistently into broad market index funds. And once I understood this, the way I invested completely changed because investing stopped feeling stressful and finally started feeling simple. I realized I didn't need to predict the future, I didn't need to read charts all day, and I definitely didn't need to panic every time the news changed. That shift alone removed so much anxiety around investing for me. Now, if this sounds complicated, I promise it's really not. Think of a stock like owning a tiny piece of one company. So if that company does well, your money grows. If that company struggles, your investment drops too. But index funds work differently. Instead of buying one company, you buy a basket of tiny pieces of hundreds of companies all at once. For example, the S&P 500 tracks 500 of the largest companies in the US like Apple, Amazon, Nvidia, and Google. So instead of trying to guess which company will win, you're investing in the overall market instead. Think about it like this. Buying one stock is putting all of your money on one horse. An index fund is owning the entire race. And that's exactly why so many long-term investors prefer this approach, because it's simpler, less stressful, more beginner friendly, and historically very effective over time. You don't need to overcomplicate this, and that's the part I wish somebody explained to me sooner. Because when I first started investing, everyone online was talking about Tesla, so naturally, I bought Tesla. And at first it felt exciting. I was like, okay, I'm finally investing. But very quickly, it became emotionally exhausting. Every Elon tweet moved the stock. Every headline moved the stock. One day I was up, the next day I was down. And before I realized it, I became obsessed. I was constantly checking my phone, refreshing the app, wondering if I should sell. And eventually I sold at a loss. I felt so defeated because that's when I realized I wasn't investing anymore. I was gambling emotionally. And that's when something finally clicked for me. Owning one company can create huge gains, but it also creates huge risk and a lot of stress because your entire return depends on one company performing well. And for beginner investors, that's a lot of pressure, especially when you're still learning. So at this point, you're probably thinking, okay, so why does this make investing feel so much easier? Let me show you exactly what I mean. Imagine Simone invests £1,000 into company A because everyone online is saying it's going to explode. Then suddenly, the company has a scandal. The stock crashes 40%, and now Simone has lost a huge chunk of her money. That will feel horrible. She'll probably panic, sell, and swear never to invest again. Now compare that to Keisha. Keisha invests £1,000 into an index fund instead. One company inside the fund performs badly, but it barely impacts her portfolio. Why? Because she owns hundreds of companies, not just one. And that's the real power of index funds. You don't need to figure out the one winner. You benefit from the overall market growing over time instead. And the best part is you get to be a lazy investor, which is actually a good thing. You don't need to obsess over investing for it to work. You can invest, carry on with your life, and let your money quietly grow in the background over time. And that's what finally made investing feel sustainable for me because I stopped trying to win investing and started focusing on consistency instead. Now at this point, you might be thinking, okay, this actually makes sense, but how do I even start? The good news is it's much simpler than people make it sound. You do not need to be an expert to start. First, open a brokerage account. Think of this like a bank account, but instead of holding cash, it lets you buy investments. Platforms like Trading 212, Vanguard, or Hard Gives Lansdowne make this really beginner friendly now. Next, choose an index fund. I personally started with the S&P 500 index fund because it's broad, beginner friendly, and proven long term. Again, you're not trying to predict one winning stock, you're investing in the market as a whole. Finally, choose an amount you can afford and start investing consistently. And this is important. The amount matters less than the consistency. When I first started, I was investing £250 a month because that's all I could afford. But over time, that consistency compounded into a six-figure portfolio. And that's the part people massively underestimate. Small amounts invested consistently over a long period of time can completely change your financial future. For example, if somebody invested £500 a month consistently into a broad market index fund at around 8%, in 16 years with compound growth, that could quietly turn into £100,000 in the background without day trading, without constantly checking the charts, and without stressing about the perfect time. And that's really the goal: calm, consistent investing, not emotional investing. Now, even if that still feels overwhelming, there's another option: a robo advisor. This is basically an app that invests for you automatically. You answer a few questions, settle them out, and it handles the investing for you. Think of it like having a financial assistant for your investments. And this is why a lot of beginners like this option, because it removes a lot of their decision making. A few of my friends use this approach. Personally, I prefer investing myself because it helps me learn. But at the end of the day, the best investing strategy is always the one you'll actually stick to. But before you start investing, there are three really important rules I wish I understood earlier, because these are the things that stop people from panicking, quitting, or making emotional decisions. Rule number one: have an emergency fund first. This is important because if all your money is tied up in investing and an emergency happens, you don't want to be forced to sell investments at the wrong time just to access cash. That's why I always keep a cash buffer first, because investing feels a lot less stressful when you always know you're financially protected. Rule number two: automate everything. This is huge because consistency beats motivation every single time. The fewer decisions you have to make each month, the easier investing becomes. The truth is, most wealth building is boring. It's just consistency repeated over and over again. That's it. Rule number three: ignore the noise. Markets go up and down. This is normal. That's not failure, that's investing. And this is why index funds help me emotionally so much, because I stopped obsessing over every headline and started focusing on the long term instead. And finally, start before you're ready. I wasted so many years waiting until I understood everything. But the truth is, confidence comes after you start, not before. Looking back, the biggest thing that changed when I stopped trying to pick stocks was my peace of mind. I stopped obsessing over every market drop, and investing finally became something that supported my life instead of consuming it. Because most long term wealth isn't built by constantly chasing winners, it's built slowly, quietly, consistently. And that mindset shift changed everything for me financially. Investing doesn't need to feel stressful or complicated. You don't need to predict the market or find the next big stock to build real wealth. The people who build wealth long term usually aren't the loudest investors, they're the most consistent, because calm money grows quietly. And if you want to know where I keep my cash before investing it, watch this video next where I break down where I keep my cash instead of just leaving it sitting in the bank. If you found this video helpful, give it a like and subscribe for more content on building wealth on a normal salary. Thanks for watching, and I'll see you in the next one.